Okay, so first on deck is Aaron. So I love Aaron because he's shorter than I am. He's the only guy I know
I think I
that's
got
here. I just interviewed the other guy. He was like 6'5". It's like talking to Steve Gal, but instead I love it. Eye to eye, perfect for me. Um, so Aaron's a former student of mine. Scott was supposed to interview Aaron, but Scott got pulled into doing his presentation next. So I volunteered to pick up the slack, which is always fun. So Aaron, first of all, thanks so much for coming. It's great to see you. I haven't seen you in a long time. It's great to see you again. And you live down here. You're the co-founder of 645 Ventures,
Yes.
one of the leading firms in the city. We'll get into that a bit. But let's just start at the beginning. How did you get into venture? I mean, it's a really hard sector to crack. I was just thinking about this. I think I have three, let me think. You, Marlon, and and Ali Ahmed. So maybe three former students who have actually started VC or VC-like funds.
Yes.
And that's it. There's a bunch of students, not that many that have gone into VC.
Yes.
I remember when you were a student talking about it. You know, I'm always a skeptic, as you probably remember from back then. It's so hard to get into. But like, what made you think that you could actually crack this sector? What about your time at Johnson gave you the inspiration?
Absolutely. Could everyone hear me? You guys hear me?
Yeah.
First of all, I can't go without just, congratulating you on this, amazing conference. I remember in 2012 when you were talking about bringing this to New York, and you've been doing this in New York for probably over a decade.
Then, yeah.
And so it's just amazing to see. So let's just give Zach a big hand for this amazing work he's been doing, man. It's just amazing to see all that you've done for Cornell. So yeah, my background, I started my career as a software engineer at Goldman Sachs building high frequency trading algorithms. I did that for several years and then went to a firm called GFI Group, which is an interdealer broker that trades derivatives. And I was brought there to really invent the way foreign exchange option derivatives are traded. At the time, they were traded by phone. So you would pick up the phone and structure these exotic options. But they brought me in to kind of really invent a new way to do it. And so as a software engineer, I was recognizing that the power of software was really changing business. But the people who were running these financial institutions that I was working for, they were not software engineers. So I said, I need to go to business school because these people were business people. And I wanted to marry my kind of technical skills with business. And with that, I thought I could run a financial institution in the future.
Yep.
And so as I was exploring business school, I came across Cornell. But Cornell has something really special at the time, and I think it still exists.
It does.
It is BR Venture Fund. And at the time, this was over 10 years ago. It's really 14 years ago. Venture capital and entrepreneurship was not as popular as it is today. And so it was unique to have a school that had a student-run venture fund. The only other school that had it was
Utah or Michigan.
It was Michigan. It was called the Wolverine Fund.
Yep.
And so I applied to Cornell. I got in, and I said I would run that venture capital fund. And while I was here, I just met amazing people who supplemented my traditional education. So when you're in business school, you're learning everything like about cost of capital and WACC, everything you would learn as a business school student. But what we got were people like Zach, people like Steve Gall, people like Professor Ben Daniel, people like Eric Young, who has since passed away, that were open to teaching this small group of people who were interested in entrepreneurship and venture capital how to actually pursue this industry.
And did you think that like you were going to run BRV, which by the way, it's not a foregone conclusion that you just come to the Johnson School and run BRV.
Yeah.
I mean, it's competitive to get into, and then you have to decide once you're in who's going to be running it. And there's all the, I like to make fun of MBAs for all their different titles and positions because there's like one for everybody. But there's only one leader. And so that was great that you got that. I remember when you did. But I mean, was it your inspiration to like leave Johnson and then go into venture capital, knowing how hard it was to get in?
Yeah. So,
I mean, and you're a minority too, which could make it even harder.
Yeah. So back then, it was very hard to get into venture capital. It's still hard to get into today, but it was really anomalous. And a lot of the people I was talking to at the time, who I was getting mentorship from, so Doug Leone, who was at Sequoia, Howard Morgan, you, Eric Young, everyone was saying you also need to have entrepreneurship experience. You have to get close to the founder and understand the types of businesses that they're building,
Yep.
and understand the founder experience in an intimate way. And so don't pursue venture capital on its own, but just pursue entrepreneurship and venture capital combined. And it may be in the future, you could be a VC. So that was kind of the type of advice I was getting. I also helped to build a part of the curriculum for eLab. So eLab at the time was in the second cohort.
Yep.
And I remember Steve Gall, I don't know if you're going to remember this. I'll never forget this. I was interviewing with Steve Gall for this. And Steve said, Aaron, how are you going to do BRV and eLab at the same time? And I said, I'm going to sleep less. That's what I said. I'll never, ever forget that. And so when I was doing eLab, I was close to the entrepreneurs.
Yeah.
When I was doing BR Venture Fund, I was kind of learning what it meant to be an investor.
Yeah.
And so when I left business school, I pursued both of those things, and it wasn't easy.
Right. So you ended up at Gotham?
Yep, I ended up at Gotham. Yeah, and so there was
and I bet, by the way, I bet you were the only person in your class that went into venture. I mean,
that year, yes.
I don't know anybody else.
Yeah, no one else went into venture.
Yep.
What people don't, I worked for free.
At Gotham?
Yeah.
So Thatcher just made you work for free?
Thatcher made, I was going to bring up Thatcher, but yeah, Thatcher, who's also a Cornell alum, he gave me the opportunity to work with him.
Okay.
And for me, what was valuable was a business card that said I was a venture capitalist.
Okay.
And so I was a venture capitalist in the New York ecosystem.
Yep.
I was kind of working with entrepreneurs. I was writing their quarterly reports. I was helping out this new accelerator at the time. It was called ER Accelerator. And it was...
Was that the predecessor? Was it ERA?
ERA,
really?
Yes. Yeah.
Which is now one of the leading accelerators in the city.
Yeah.
Right, yeah.
Yeah, I was there on the ground floor.
Wow.
So,
okay.
So funny story about ERA. When I was running the BR Venture Fund, there was an entrepreneur who pitched us, and he was in the first cohort of ERA. And so my first week after business school ended, right? So all of my business school friends, they went off to their fancy jobs at consulting firms, yep, investment banks. And so I came back to New York trying to figure out what I was going to do with my life. And I reached out to this entrepreneur who had pitched us at BRV, and he had just finished this ERA accelerator cohort. And so he said, let me introduce you to the founders of ERA.
Okay.
So I go up and I meet the founders of ERA, and I said to them, hey, can I work with you guys? I just finished business school. I would love to get involved in the New York City ecosystem, et cetera. And they said, well, we just finished a cohort. We're not going to start our next cohort for 3 weeks, and we're moving, so we don't have any work for you. Next week, we're moving to this new place. We have to paint walls and things like that. I said, I know how to paint.
Sign me up.
I said, I know how to paint, so bring me in, and I'll kind of help paint your walls. And then they said, John said, man, he said, Micah, check this out. He said, Micah from Founder Collective.
Yeah,
I'm like, yeah, he's a part of the Cornell.
Micah's also a Cornell
system.
Yeah.
And he said, do you know how to model? I said, yeah, of course I know how to model. I worked at Goldman Sachs. I went to business school. I can model anything. He said, come next week and build a portfolio construction model. And so I built them this portfolio construction model that they pretty much used for 10 years. And what was interesting about this is a little bit over a year later, because I was helping out with their accelerator, meeting lots of entrepreneurs, I met my co-founder of 645 through an entrepreneur at ERA who said we were speaking the same language. So she introduced us because she said that the way we saw the world and how we were thinking about what the future of venture capital looked like was similar.
Yep.
And so that's how I ended up with connecting with Nambi through an entrepreneur who I met at ERA.
Yeah.
So I took this very like unstructured, episodic path that led me to my passion.
So this whole thing about unstructured, this is a common theme today about unstructured career paths. And so I love it because that's the way mine was. And, it's just you take advantage of the opportunities as they come up.
Yeah.
And you clearly did. How'd the painting come out, by the way?
Well, I ended up becoming a model. So I ended up modeling for them instead of
You got out of the painting. Okay.
Yeah, they say you can
Fair
model.
enough.
I'm like, yeah, I can model.
I actually like painting too. Okay, so you and it's Nambi?
Nambi.
Nambi get together and you decide, okay, let's launch a fund. Like launching a fund is really freaking hard. Like there's no doubt about it. And you brought a software background to the table. Nambi brought more of a VC background to the table. Like, but what made you think you were going to raise money and launch a fund? How big was your first fund?
So the first fund was 7.6 million.
Okay. So small.
It was small.
Yeah.
Yeah. So to go back, I didn't know that I really wanted to start a fund. I knew that I wanted to be a great investor one day. But when I was at DFJ Gotham, I started to recognize what I was calling structural changes that were happening at the early stage of venture capital. And it appeared that these structural changes would create a way to build a new type of venture capital fund that never existed before. So for us, building a venture capital firm was not just building a boutique investment shop that's modeled after what we had seen before, but we were pursuing something completely different than what had existed because of these structural changes. And I had only read about this type of market dislocation. So when I was at Goldman, when I started my career, we read all of these crazy books with crazy titles like More Money Than God. I didn't even know God had money, right? Like,
dude, God's got money.
Yeah. When Genius Failed, Liar's Poker, all of these books, the partnership about like Goldman Sachs and how Goldman Sachs came to be, Kings of Capital, which is about Steve Schwartzman.
Like, were these all required readings? Like they didn't tell you as an associate, read these books, did they?
They may have mentioned one or two books,
Okay,
but I kind of really enjoy like studying kind of what I was involved in.
Yeah.
And I read all of these books. But what I remember about reading those books was that there were these massive shifts that created opportunities to do finance in ways that hadn't been done before. So if you think about KKR created the leverage buyout.
Yep.
Right. And so I thought that I would never see any type of dislocation like that. And so I always thought I would work somewhere and like climb to the top. But when I got into the venture capital world, there were massive shifts happening. So the first shift that was happening was the rate at which new companies were being formed were outpacing the networks of general partners and their associate teams. So deal volume was going up dramatically. And deal volume started to go up dramatically at the early stage because of reduced complexity to code, increased entrepreneurial interest in the economy, low cost of building something. And then we were all starting to walk around with computers on our pockets so developers can ship software to people in real time and ship updates. And so more and more people started to participate in entrepreneurship. If you think about how seed stage venture capital worked, that was breaking down the network-driven sourcing paradigm for venture. So network-driven sourcing is constrained based on where you live, where you work, right?
Yep.
And so, but startup formation was happening all across the country very rapidly. So that was structural change. One, that I thought if you could build a software system that could augment your network, you could see more deal flow than anyone else. The second structural change was the amount of information on pre-Series A companies started to move online at a greater pace. So you can figure out website traffic. You can figure out app store downloads. You can figure out whether founders worked together in the past, who they worked with. You can tell whether or not a GitHub project was gaining stars. And all of this information was fragmented across the internet and not centralized in any one place. And so if we could build a database that can gather that information using websites as a unique key, you could actually, and then you can score all of those opportunities, you might be able to see something that you would not have historically seen. And so these structural changes, the third was really about doing due diligence at the early stage. How do you bring growth stage due diligence early? And so these were the ideas that I was playing around with, as well as my co-founder, Namdi, that Karen Moon said we were speaking the same language, that motivated us to say, you know what, let's not try to climb the ladder. Let's build something new. And that's kind of what we set out to do. And
so you actually built a software product to enhance your firm. I don't want to say run your firm, but enhance your firm and your offering. Can you explain a little bit? And before you do, by the way, I still can't believe Thatcher didn't pay you. I'm like, we got to do something about that. Okay. But explain what the software does, like day to day, as you operate your firm.
Yes. So the software, we call it a software operating system. So it does a lot of different things. So it can do, think about it as multiple apps. So one app is called Candidates. So candidates can go out to multiple different sources on the internet, like Crunchbase, PitchBook. There's multiple different sources, WebTrack, SimilarWeb, App Annie, all of these things. And it finds companies, scores them, and it surfaces them for us. So almost like every single day, there's a demo day at our firm, right? Because the software is kind of constantly saying to our junior team, hey, take a look at these opportunities. So that's one, call that one feature.
And are you guys focused mostly on software companies as well?
So we invest in enterprise software, infrastructure software like developer tools, and then occasionally we'll do consumer.
Okay, consumer software or consumer
like consumer software or like, have you heard of Goldbelly? It's a marketplace that allows you to get food.
Yeah.
So that's a direct to consumer. It's kind of B2B to C.
Gotcha.
Right. And so that's one of multiple different features that exist in our software called Voyager. Another thing is we have pacing models. So every action that you do in the firm, everything ranging from sourcing a company, whether it's through our software or your network, to creating a due diligence item like building a market map, everything is done and tagged in the software. And you get points for everything you do. And there's a leaderboard for all of the points you accumulate. But we can
amongst your employees?
Amongst an employee, yes.
I love it.
And so it kind of operates like a sales organization. So we have quotas. There's a certain amount of calls everybody has to do. There's a certain amount of outbound that you have to do. There's a certain amount of research you have to do. And so all of that information is tracked and organized within the system. So effectively what we have invented is how to do high volume sourcing and due diligence at the earliest stage of venture capital.
It's incredible. So then once you make an investment, does the investment get monitored also through the software? Does the software generate new ideas that might be good for that company?
Yes, we do both. So we have something that we call strategic finance. So we have a team on a finance team that uses our software as well as another software called Fireside, where we're kind of sending surveys to all of our founders so that we can collect. There's two types of data. There's manual data and automated data. Automated data is information you can get off the internet that's constantly being updated about the company. Manual data is data you have to collect directly from the source. And so our finance team is kind of constantly collecting information on our portfolio and then on a quarterly basis, ranking those companies into quartiles and then working with our success team to come up with projects that can help increase the equity value of our best performing companies. We call those offensive projects. And then on the defensive side, anything that looks like it's really not doing well, it may need a soft landing or some help. They're also doing work on the defensive side. So there's a whole operation running.
Like might the software actually identify potential acquisition takeouts?
So that's a human research type of project. So the software is not going to tell you, hey, this is the company that's going to buy your company. The software is going to say, based on the burn rate and like how revenue is slowing. Like this company's, they're saying they have 12 months, but they really probably have 8.
Okay.
And so our strategic finance team will reach out and engage with them.
Yeah.
And that team has relationships with investment banks and like boutique investment banks that can help facilitate acquisitions.
So do you know of other VC firms that have this operating software?
There's not many. I was talking to Josh Koppelman earlier today. We were just catching up. I was showing him some of the things that we recently built. It's not many, actually. And I think that was also a part of the excitement.
Right.
When we started to realize that software played a role in the venture operation, we started to try to figure out who else, this was 10 years ago, was doing it. And at the time, no one was really doing it. Now, a number of venture capital firms are buying off-the-shelf software. Some teams are kind of building software internally. But one of the secrets is that, and this is also what I learned at Goldman, is that your software engineering team has to work very tightly with your investment team so that you can co-create and innovate together. That's kind of one of the secrets. It's like it's in the culture of the organization.
Okay.
And also adoption, like the members of the organization really believe. So they're working in the software all the time. So someone who has been running a venture fund for 10 years, it's very difficult for them to all of a sudden change the way they operate, to have software at the core of everything that they do.
Yeah, it's incredible. Let's, if you don't mind, just brag a little bit. So first fund was 7 million. Second fund was
40.
Third fund
160.
Fourth fund
350.
So that's a pretty good trajectory, right? Congratulations. So you're now investing out of that fourth fund.
Yeah.
And I think you told me you also launched an opportunity fund.
Correct.
Why don't you explain what that is for people who don't know?
Okay, great. So when we raised 350 million, that is broken up into 2 separate funds. It was a $200 million core fund. That core fund represents our core strategies, C through Series A investments. There's a $150 million select fund. So the select fund is kind of like the greatest hits album across all of our earlier funds. So funds 1 through 4 will produce a number of big winners, right? Because venture follows what's called the power law distribution. So a small number of companies actually represent a large percentage of the returns. And so once those small number of companies are identified, you want to concentrate as much capital into those companies as possible. Well, our core fund can only put so much money into those companies because we have a portfolio of 30 for enough diversification so that a big winner can emerge. And so the opportunity fund is the opportunity to continue to invest the pro rata generated by the earlier stage, the early companies. So when we were raising or getting ready to raise our fourth fund, our LPs were saying to us, you guys are continuing to leave a lot of money on the table because we never raised SPVs. So special purpose vehicles usually get raised when you have a breakout winner, but your core fund doesn't have enough money to put more money in. Because we run such a tight organization, we never wanted to kind of stop running our organization or raise more money just for this one company. So when we raised Fund 4, we said we would raise a dedicated vehicle that can concentrate money into our best performing companies without having to raise multiple special purpose vehicles.
Yeah. Did you let any LPs into only the opportunity fund, or did you require them to be in the core fund?
Good question. This is a very good question.
Yeah.
So
sometimes I ask good questions.
Yeah, you always ask. So we stapled the funds together.
Yeah.
So in order to invest in our fund, core fund 4, you had to invest in the opportunity fund.
Okay.
What we didn't want to do is break up the fundraise. Because what you could imagine happening is there's a lot of demand for the core fund, but then not enough demand for the opportunity fund, which would ultimately elongate the fundraise. When we went to market at the beginning of 2022. And in our software, we saw that the market was at a peak because we are monitoring median entry prices for investments. And so when we were looking at that graph, it was almost like a vertical line up, because in 2021 and at the beginning of 2022, we were kind of at the height of the market. And so we said to ourselves, okay, if we're at the height of the market and the air starts to come out of the balloon, this is what the Fed was actually starting to suggest, that they would lower interest rates, that you might see a market correction. And so because we were going into the beginning of 2022 with that information, we wanted to execute a fundraise very quickly.
Yeah.
And so we stapled the funds together.
So I would think also for some investors, the opportunity fund would be more attractive, even though the return multiple probably won't be as high, because later stage companies, look, I mean, you're looking for 3 or 4x. That's great.
Yeah.
So I think it's interesting that you had a greater demand for the core compared to the opportunity. I almost would have thought it would have been reversed.
I'll explain why that's the case. So at this point in time, a lot of early stage funds, seed stage funds, were also in market raising these opportunities funds. And as we got later into 2022, it was clear that the market was correcting itself. And there was concern whether or not seed stage managers would be able to properly underwrite growth stage deals. And so LPs really wanted to have their growth stage managers managing growth stage capital and their early stage managers managing early stage capital. The benefit that we had was we built an organization that has a lot of growth stage DNA and institutional DNA. So Nnamdi came out of Insight, which is a growth equity fund. We have people who joined us from Thrive. We have people who joined us from Vista Equity, Volition. A number of us came from Goldman Sachs. So we were able to convince the LP base that while we are dedicated to the early stage, we actually have late stage kind of DNA.
Yep.
And we're going to apply late stage investment practices to every investment that we make out of the growth stage.
I get it. So I mean, you know this, but for the people in the audience might not. And when Sequoia or Andreessen raises an opportunity fund, the investment managers are completely different than the early stage funds.
That's right.
Different folks. Okay. So you're up to 21 people, 500 million under management. I mean, it's just fantastic. I'm curious if you could tell us, let's focus on Cornell Tech for a second. So here we are, Cornell Tech. You heard Greg this morning. You know, I remember when it was in the Google building. I was there, 7 people. And here we are with 700 going toward 1,000. You're involved with the governance at Cornell Tech on the governing board. Tell us what you think Cornell Tech has meant to New York City.
Oh man, I think it's been really important for New York City. So if you think about some of the things that make San Francisco magical, it's kind of a deep technical talent.
Yep.
That that also have been at companies that have gotten to really large scale. And so it's going to take time for the New York ecosystem to see more and more winners that get to scale, like MongoDB might be an example of one. But it's going to be even more important for us to have a deep bench of technical talent that can pursue opportunities that are part of large tech waves. So if you think about crypto or blockchain as an example, we've had a number of people who have come out of Cornell Tech who are tightly integrated into that ecosystem.
Yep.
Like Raphael Pass with Thunder Token, Argoon with Avalanche,
yep.
Right? So these are very important technical problems that are being solved by people who are coming out of Cornell Tech. Or right now, from an AI standpoint, there's Sasha Rush who works with Hugging Face. Right. And so we need in New York City kind of more deeply technical talent, and Cornell Tech offers that. In addition to that, Cornell Tech has created a educational pedagogy, which I was a part of with Greg Pass, called The Studio, that not only brings forth technical talent, but also it creates an opportunity for business school students, LLM students, design students are coming next to all co-create together. And that is going to continue to create opportunity for people with different perspectives and skill sets to come together and build and think about new things.
Yeah, it's incredible. So another loaded question, because of the election. So, and when we talked about this, we didn't know who would win.
Yeah, yeah.
Okay, now that Trump has won, and by the way, we haven't talked about politics much all day, which is kind of nice. So, but Aaron and I wanted to talk about a little bit. So, how do you think that the election outcome is going to impact VC, if at all?
Yeah, yeah.
I know it's a wild card. I mean, Elon Musk is there. Who knows what he's going to do?
Yeah. So the election last week, the biggest surprise to me, and the thing that we're paying the most attention to at our firm is what's called unified control. So what happened last week was a single party has taken the presidency, the Senate, the House, as well as from an ideological perspective, the Supreme Court. And so what that can do in a society is create mass change from a policy standpoint. So as it relates to our industry, so you can have in that, the changes that can come from a policy standpoint can impact companies, industries, and people personally,
Yep.
livelihood, education. So it's a multiple different areas of the society that can undergo a change. As it relates to entrepreneurship and venture capital, there's a few things that we're paying close attention to. One is how might liquidity change? So over the last couple of years, you've seen a massive slowdown in companies entering the public market. You've seen kind of a meaningful slowdown in M&A.
Yep.
And so with this type of change of control and interest, you might see a scenario where you can see increased M&A. And how could that happen, right? Well, the FTC has blocked a number of massive M&A transactions because of beliefs and policies and ideological views around antitrust and monopolies. Well, that can be lessened, right? And if you lessen that, you might see some large-scale M&A go through, which may unlock liquidity from an LP standpoint. So we're paying attention to see if that can in fact happen. From a public market standpoint, there could be regulatory change that can enable companies to go public with less friction. If you remember in the last administration, and this is not the first time this has happened, but it's the first time in my professional career I saw it, was like the rise of the SPACs, right? Well, how does something like that happen? It's because it's like deregulation and less emphasis around kind of what is required or restrictions required about getting into the public market. And so I think there's a possibility that you see kind of more activity in the public market. The stock market did rally, and so did crypto.
Yeah, except for the last 2 days, it kind of unrallied.
Yeah, so we'll see. Yeah, so there will be volatility there, but even on a liquidity standpoint, from a liquidity standpoint, you may see more with crypto.
Yeah. So it doesn't sound like you're too nervous.
Not about the venture capital industry. Now, maybe nervous about other things. Yeah, there's a lot to be worried about, and there's a lot to be excited about if you're in this industry.
Yeah. Okay. I'm going to do one more question, then keeping track of time, then we'll open it up to audience. You guys got your mics? Okay. What do you think about tech hubs? Miami, New York, Boston, Bay Area?
Yeah, I mean, I don't know if my views are going to be too provocative, so don't hold me to it. So New York City, I've been really delighted to see the amount of talent that has been concentrating in New York City, particularly following the pandemic. So following the pandemic, New York bounced back pretty quickly. And then when that happened, we started to see a number of people from different hubs kind of come to New York. We saw it happening with portfolio founders, and we started to see even more entrepreneurial activity, as well as top tier West Coast venture capital firms opening offices here. Yeah. And so I think New York, I'm bullish on, super optimistic about what's happening. I think crypto saved San Francisco. I think not crypto, I'm sorry, AI.
Oh, okay.
AI.
I was thinking.
AI, my bad. AI.
This is going to be provocative. Okay.
Yeah, AI saved it because right before we saw like the massive boom, the public boom of AI, like it felt like San Francisco was going downhill. So we have a San Francisco office. So we have offices in New York and San Francisco. And it was kind of, to use some of language from some of my colleagues, female colleagues, when they would go out, they said they didn't feel comfortable and safe. This was like before. But then
just walking around the city.
Just walking around, and there wasn't as much activity as we were seeing in New York City. But when the AI wave hit, it just kind of started to bounce back again. It's like the magic of San Francisco was kind of started to build on itself. And so now our team members, we have team members who are spending more time out there, we're hiring out there. So I think San Francisco is going to continue to see a surge. Miami, during the pandemic, a lot of wealthy people moved to Miami. I wonder why. Hedge fund managers, VCs, crypto folks. But what we have started to see, I know a number of people younger folks, are leaving Miami and coming to New York. Older folks are kind of staying rooted. But so I'm not sure exactly what's going to happen with Miami, but I do see a number of younger people coming back. Yeah. Maybe if crypto kind of resurges, you might see the ecosystem ramp back up, but I'm not too bullish there. Yeah. I think it's hard to bet against Boston. You have Harvard, MIT there. I think bio in this generation is I think we're gonna see a tremendous amount of innovation in bio and biotech. And I think they continue to have a strong hold there. Yeah. Super. Thank you so much for the conversation. Yeah. Okay, I want to open up for questions. We've got some questions. I see one in the back already, kind of in the middle.
Hi, I'm an undergraduate student at Cornell, and I'm interested in breaking into venture capital. My question for you is, do you see a possible scenario in the near future where the big tech companies maybe lose their power and grasp that they have, or do you see a continued trend in the increased power that they have?
Wow. What's your name?
My name is Jenna.
Jenna, thank you for that question, Jenna. I think the big tech companies that we know of today were at one point in time the disruptors. Amazon, Facebook, Google. And this massive tech wave that we see now, AI, they understand that technology can really disrupt their industry if they don't move quickly. Amazon does not want to be Toys R Us. And so what's going to happen is, or what we see happening is, large tech companies playing a much more active role in kind of the innovative economy, particularly around AI. So a lot of those larger companies are investing aggressively. In addition to that, they have a few competitive advantages as it relates to this wave. One is distribution. So they already have a large number of people who they can reach their user base. They have proprietary databases. So I think AI is fueled by proprietary data. So in the prior tech wave, you can have a person build Instagram in their garage or at their house and scale quickly enough to be bigger than, or potentially compete against the prior social networks without any friction. I think in the AI wave, some of the best companies are going to have data that allow them to do things that people without data cannot do. And the large companies have that at their disposal. And then they have large amounts of capital that they can use to invest in these categories. And if we go into an environment where antitrust and monopolies are much more it's easier for those things to kind of come together, then they will be able to aggregate power. So that's kind of what I think about what's going to happen with some of the larger tech companies.
Interesting. Right in front.
Hi, Aaron. My name is Christina Sanchez. Thank you so much for speaking with us today, and congratulations on all your success. I'm curious if you could talk a little bit more about how you built your team and how you selected the individuals around you to kind of build that success, because I know, I mean, it seems like you're very smart and very successful, but surrounding yourself with those people that can really help build you up. I'm just curious how you thought about building out your team.
Yes. So that has been the hardest part, right? So we had this idea around how the venture world could work and how software can work to create an advantage. But the hardest part is, how do you create a culture that buys into the system, people who love to come to work and work with each other every day. And so we've put as much thought into architecting that culture as we have to our system and how we make investments. So I'll kind of walk you through just a couple of examples of what this looks like. So we call it a learning culture. So we start the week with the all hands. It's completely, the entire firm joins the all hands, and we do something called trip reports. We learned this from, it's a book called $1 Trillion Coach. I think his name is Bill Campbell. He's a really big coach on the West Coast. He coached a lot of the top Silicon Valley executives. And the reason we do trip reports, where we talk about what is going on in our lives, what's going on in our families, is because as we debate each other, as we engage with each other, we want to do so with empathy. And the way you do that is by understanding what's going on in the lives around the people who are around you. So in the trip report, you'll have a week where someone just got engaged. You'll have a week where someone had a death in their family. You'll have a week where somebody might be going through a divorce or something like that. And we are really there to support and engage with each other, so that later in the day and later in the week, we are more mindful of how we engage with one another. Another thing that happens, this happens every Monday. Another thing that happens every Monday is something called Learning Corner. So the Learning Corner is, there's a few sayings in the firm. One of them is the great study the great, right? So if we want to be a great place in a great firm, we have to study people who have been great and institutions who have been great before us. And so what we do is all read the same thing over the weekend. It may be a podcast, it might be a blog post, it might be a chapter from a book. We might have Howard Morgan has come into it. We invite leaders to come into the Learning Corner, and we all are learning something new together. And then afterwards, we start to think about, are there things that we learn that we can incorporate into our personal habits? Or can we incorporate these things into the habit of the institution? And so there's multiple things that we do as a firm that create a culture where we're investing in the people who are there.
Heck, I want to come work for you. And get this. Okay, one more over here, Amanda.
Test.
Yeah, you're good.
Thank you. My name is Yalverton LeCan. I currently work at Cornell. First, I'd like to thank you for being here and sharing your great experience. It's been very insightful. So my question is, when you first started your fund, which was, I think you said $7.5 million, can you speak about how much risk you did not take in that fund, and have you kept that same methodology in the other funds?
Wow. Yes. What's your name again?
Yalverton.
Yalverton. Yeah, so risk, that's a great question. So because that fund was really small, it was, 7.66 million, there was a confined amount of risk that we could take. So there was risk that we did not take because we just didn't have enough capital. And so as we raised larger and larger funds, we started to explore larger addressable market opportunities. So take as an example, in the current funds that we have, we are now looking at defense tech as a category. We've been investing in defense tech for the last 2 years. But if you go back to the first fund, we couldn't even think about exploring something like that because of the cost of capital, CapEx, all types of, multiple fundraising rounds that would happen after your first investment that we didn't really feel like it might be a good place to start. And so as we've gotten larger, we have explored taking more risk. Also stage, when we first started, it was primarily pre-seed and seed. But as we've grown, we've been able to come in at anywhere from a pre-seed to a Series A. So we've also diversified risk across stages.
Excellent. Aaron, thank you so much. It's been fantastic.